Well, we're in a virtuous cycle. Unemployment is low and falling. That's causing wage growth to accelerate. That's supporting consumer spending, causing businesses to hire more, which causes unemployment to fall lower. So that's a pretty significant, difficult thing to break. That's that cycle. And that's my fundamental reason for optimism. There's other reasons, but that's a fundamental reason.
But isn't, you also point out that retail sales after Christmas have basically slumped, and business investment is kind of flatlined. Seems to me that's a little bit onerous.
Yeah, I mean, I'm making some assumptions, right? In case of business investment, I'm assuming that the president's trade war does not escalate, that he figures out a way to come up with a face-saving arrangement to end that battle with China, and that fades off the front pages. I'm assuming that the government shutdown doesn't continue on for months, maybe weeks, but not months. I'm assuming that the Treasury debt limit, which is another issue that's coming up this spring, we resolve that. So there's a lot of assumptions, a lot of red flags, but everything suggests that 2019 should be an okay year.
I want to get a little bit more into more detail on the shutdown, because we've heard a lot of folks saying, well, if it goes on much longer, it's going to be more of a problem. I mean, how much longer? How do you model it? And I'm also curious about the sort of secondary effects, not just of people who work directly for the government, but the potential hit to consumer confidence more broadly.
Yeah, it's tough to estimate. You can go back to the 2013 shutdown or the 95, 96 shutdowns to get a sense of how this might unfold. This is a bit different because it's only 1/4 of the government. Also, the administration is kind of triaging things. We're going to get tax refund checks. The food stamps are going to get paid out. Things that otherwise might not have happened. But under reasonable assumptions, this is a huge hit to the government workers, obviously, but it's not a big deal to the economy just yet. But if we get into February and into March, then the wheels start coming off. I mean, the Small Business Administration can't make small business loans. Farmers can't get financing. FDA can't do its inspections. Ports will be disrupted. The thing that would really be disruptive is if government workers decide to bolt, right? I mean, the job market is very tight. Unemployment's low. There's a lot of job opportunities, a record number of opportunities. Suppose they leave their jobs. Then what? Even if the government reopens, then the government can't really get going here. So it's not a big deal now, but if you look at a month or two and this is still going on, then it's a problem.
Hey, Mark, it's Brian Chung here. So, I mean, you mentioned employment. I think this is really interesting because I think the Fed is in a little bit of a dilemma here. I mean, when you think about that blowout jobs report for December, you realize how many job payrolls they added during that month, but then also unemployment somehow ticked up. So, I mean, I'm curious to hear what your thoughts are in terms of the labor market right now, and kind of whether or not the Fed is actually maybe a little bit farther from its maximum employment mandate than maybe they thought they were.
Well, we're creating a lot of jobs and well above the number needed to maintain a stable rate of unemployment. So, unemployment goes up and down and all around month to month, but at this pace of job growth is sustained and everything suggests that it's going to be strong. We'll see unemployment continue to decline. If you told me the unemployment rate, right now the unemployment rate is 3.9%, if it's in the low threes a year from now, which sounds about right to me, that would argue the Fed has more rate hikes to implement in 2019. Not what the markets expect. Markets currently expect no more rate hikes in 2019. I expect at least 2, perhaps even 3 rate hikes this year.
Mark Zandi from Moody's Analytics, thank you for joining us here on The Move.
Thank you.